Leonard, do you want to mute? Leonard? Okay. Sorry, that was my colleague. Okay, we are live. All right. Okay. I'm going to share my screen. Okay, you guys can see the screen just fine? All right. Let me just check. Okay. Good evening and welcome everyone to another Driven to Learn webinar session. My name is Josephine and I'm your host this evening. Tonight we have two special guests from the Singapore Exchange with us. They are Liren and Wei Chin. They'll be sharing with us all about ETFs, or better known as exchange traded funds. If you've always wanted to know more about ETFs, you're at the right place. We are also streaming this webinar live on Facebook. So if you know someone who would like to catch this session right now, simply head over to our Facebook page right here, CGS-CIMB Securities Singapore. Right, a disclaimer before we go any further. All information provided in this webinar serves an educational purpose and is not intended to be personalized financial advice. Viewers, you're reminded to always do your own due diligence before committing to any financial products or services. Do consult your financial advisor before making any decisions. Right, with that out of the way, allow me to introduce CGS-CIMB's Driven campaign, which runs from July till December this year. Let's watch the video. All right. Okay. Okay. So that was CGS-CIMB's Driven campaign, and as mentioned in the video, it runs till December this year. And this is the reason why CGS-CIMB Securities Singapore has been hosting all these Driven to Learn webinars as well. So if you're interested to participate, scan the QR code right now on the screen and register for the campaign. All you need to do is register, open a CGS-CIMB trading account, and trade to earn as many tickets as possible to win monthly Apple products and participate in our grand draw to win a Tesla Model 3. All existing CGS-CIMB and Prosperous clients are automatically eligible for this campaign. So do remember to trade more and trade often. We have about 3 more months to go till December, end of December. So then there are 6 Apple prizes to be won each month. This means Counting this month, September, we still have 24 more prizes to give away. So 1 out of the top 10 traders at the end of our campaign will walk away with a brand new ride, a Tesla Model 3. So hurry and trade your way to the top. All right, so it's time for us to start. And as mentioned, we have 2 speakers from SGX today. So let me quickly introduce them. Today we have with us Liren, and he's a product sales specialist at SGX and drives investor adoption for securitized products listed on the Singapore Exchange. These include exchange-traded funds, daily leverage certificates, and structured warrants. He also manages key client relationships with securities brokers. We also have with us today Wei Chin, who is an ETF product manager within the Equities group at SGX. He takes charge of ETFs business development and works closely with ETF issuers and distributors on various industry initiatives, such as product development, sales, and marketing. So in this session, the speakers will touch on the basics of ETFs, share commonly traded ETFs by investors, and explain how you can use ETFs in your portfolio construction. Tonight, they are also here to answer any questions you may have about ETFs. And they will also tie this topic back to the title, for Millennials, why you should start investing early. So without further ado, I'll pass this session on to our speakers. So do take it away, gentlemen.
Thank you, Josephine. Let me just share my slides.
Sure.
Are you able to see the slides?
Yes. All right, full screen.
All right. Okay, so good evening, everyone. Hope you're well and staying safe. So thanks for choosing to join us this evening by the webinar organized by CGS-CIMB. So my name is Liren. I'm a product sales specialist with the Singapore Exchange. Together with me is my colleague Wei Chin, who is our ETF product manager. Tonight, we'll take about 45 minutes to share with you about exchange-traded funds and how starting early can give you an edge in your investments. Before I begin my sharing, here's the disclaimer for our presentation tonight. Do note that advice should be sought from a financial advisor regarding the suitability of any investment product before investing or adopting any investment strategies.
Oh, sorry, Liren, do you want to go full screen for your slides?
Is it not full screen now?
Oh, it's not full screen yet. Yeah.
Probably the wrong screen. Maybe it's the other one. Yeah.
Give me a second, yeah.
No worries.
Is that the correct screen?
Yes, perfect.
Yep, all good now.
Okay, awesome.
Let's
Thanks,
go.
Joe. Okay, so let me share with you on the flow of our presentation. I'll start off with an introduction to ETFs, where we'll cover the basics of ETFs, what are the benefits, risks to investing, and how ETFs are created. With a better understanding of ETFs, I'll move on to an overview of the different ETFs available on SGX, highlighting some of our recent launches. And I'll close off my section with sharing 2 commonly traded ETFs on SGX, namely the STI and Gold ETF. Passing on to Wei Chin, he'll be speaking on a segment that's popular with investors, which is Reits, and what are the REIT ETFs available. In recent years, there have been more yield-seeking investors who use ETFs to gain exposure into the fixed income market, and Wei Chin will share what's available on SGX shelf. Having covered ETFs, he'll then move on to share what we think are the 3 main reasons investors should start early in their investing journey. Finally, wrapping up with some of the SGX tools and content which will be useful to investors who wish to start investing in ETFs. So without further ado, let's begin. So what is an exchange-traded fund, or ETF in short? Essentially, an ETF is a low-cost instrument which seeks to track an underlying index or asset class. So it's important to note that ETFs do not seek to outperform the market. Investors buy and sell an ETF on exchange during trading hours and may use ETFs to diversify their investments. Citing an example, of an investor looking to get exposure to the Straits Times Index, which is a benchmark for the Singapore stock market, an investor can get access to 30 different stocks that make up the STI through buying one share of the STI ETF. You may ask, who invests in ETFs? The answer is that ETFs are used by a wide spectrum of investors, ranging from institutions such as pension funds, insurance companies, sovereign wealth funds, and hedge funds, individual investors like you and me, and digital platforms such as robo-advisors and regular saving plans. In terms of Sjx Etf holdings, institutions make up the biggest client segment that invest in ETFs, contributing to 67% of total ETF holdings. And this is shown in the dark blue section in the chart. So diving deeper, we have seen strong participation from individual investors in our ETFs, making up 22% of total ETF holdings, shown in green. For the different market participants, ETFs are used in portfolio management for various asset allocation strategies and portfolio rebalancing. Now, I'll share on some of the key benefits of investing through ETFs. The first benefit is that ETFs offer diversification across a range of asset classes such as equities, Reits, bonds, and commodities. This decreases an investor's risk when compared to investing in a single stock. Investors who are keen to gain exposure into international markets like the US, China, or Asia can use ETFs to do so. The second benefit of ETFs are its accessibility and transparency when compared to mutual funds or unit trusts. ETFs are traded on exchange with real-time bid offers throughout the trading day. An important concept of ETFs to note is that of the net asset value, or NAV. This represents the value of all securities held by the ETF minus any liabilities and divided by the number of shares outstanding. Investors can rely on the NAV that is published daily by the ETF issuers on their respective websites. Thirdly, ETFs offer price improvement. And this happens when an investor executes their trade at a more competitive bid-ask spread compared to buying all the underlying securities individually. So using the Reits ETF as an example, if an investor were to buy all the underlying securities, the total weighted average spread would be around 53 basis points or 0.53%. So compared to only 30 basis points when trading through an ETF. Lastly, when compared to unit trusts, ETFs are more cost-effective and provides returns closer to the underlying index due to lower management fees and the absence of sales charge or commissions. The bar chart shown from left to the right is a comparison of the 10-year performance of a particular index, an ETF, and a unit trust. As illustrated, the total fees incurred by an ETF is lower when compared to unit trusts. So having learned about the benefits which ETFs offer, investors should fully understand the various risks associated with ETFs. Number one, the underlying which the ETF tracks is susceptible to market volatility. Thus, any changes in market conditions will lead to changes in the ETF price or value. Number two, in the event that the market maker fails to provide a continuous bid or ask quotes on the secondary market, liquidity is affected and investors may not be able to buy or sell an ETF timely and at a fair price. Number three, fluctuations in exchange rates may affect the ETF price and any corresponding gains or losses in the investment. Number four, as ETFs are primarily used to track a particular index, a high tracking error indicates that the performance of an ETF deviates from the performance of an underlying that's tracking, hence not being able to meet its investment objectives. And lastly, if the underlying securities of an ETF are illiquid, the bid-ask spread widens, and this could result in a failure of the redemption and creation process, resulting in the ETF being traded at a premium or discount. So most investors will be familiar with how ETFs are traded in the secondary market, which is the diagram labeled 1, where they will refer to the bid and ask price when executing an order. A unique feature of ETFs is that it has at least one designated market maker or DMM who will be quoting on both the bid and ask price during trading hours. So this ensures that investors can buy or sell the ETF easily. In addition to the ETF liquidity that investors see on screen, there's also a primary market, which is the diagram below in teal, which allows investors to execute block transactions of the ETF through a creation and redemption process. And this process would typically be applicable to investors who are looking to execute larger order sizes. In the next section, I'll give an overview of the Sjx Etf market and highlight some of the recent ETF launches. Sjx holds a diverse range of 31 different ETFs with total AUM of slightly over 10 billion Sing dollars. And this is managed by 10 local and global fund managers, which are shown on the bottom right of this slide. The various asset classes on offer are shown in the pie chart on the left. Equities, which is made up of domestic equities shown in green and foreign equities in purple, commodities in red, Reits in yellow, and fixed income, which make up the rest of the pie chart. For Sjx listed ETFs, the asset class with AUM with the largest AUM would be that of the China Renminbi fixed income ETFs with AUM of about Sing dollar 2.4 billion. This is closely followed by Singapore equities ETFs, which track the domestic market with a total fund size of 2.3 billion Singapore dollars. The Singapore dollar fixed income ETFs and gold ETFs are two other asset classes with sizable AUMs of 1.8 billion and 1.4 billion Sing dollars respectively. In this slide, we have compiled all the 31 ETF names, and they have been categorized by asset class and geographical regions. Some of the more ETFs that I would like to highlight is that Sjx hosts the largest REIT ETFs in Asia ex-Japan region with combined AUM of 600 million, and this is shown in the bottom row. So for fixed income, the combined AUM across the 8 fixed income ETFs is 4.8 billion Singapore dollars, and these ETFs offer investors access to government and corporate bonds across Asia Pacific region. And we have also 5 China-focused ETFs covering A shares, H shares, and the ADR market with a combined AUM of 500 million Singapore dollars. In the past 5 years, we have seen a total of 10 new ETFs listed on Sjx. Back in 2016, the first REIT ETF was listed by Phillip Capital, and this was followed by 2 other issuers listing REIT ETFs in 2017 and 18. The suite of Sjx listed ETFs continued to expand in 2018 with the addition of CNY and SGD fixed income ETFs. Notably, CSOC and NICO-AM launching ETFs which provided investors with access to Chinese government bonds in 2020. More recently, Lion Global Investors listed 2 China-focused ETFs, namely the Hang Seng Tech ETF in 2020 and the China Leaders ETF in August this year. So 2 of the most actively traded ETFs on Sjx are those that track the Straits Times Index or STI, with a combined AUM of 2.2 billion Singapore dollars and daily turnover of around 7 million. So it offers investors instant diversification into the top 30 listed companies on Sjx, with both ETFs having low total expense ratio of around 30 basis points. In 2020, Sjx saw record inflows for the 2 STI ETFs on the back of higher investor adoption. The STI tracking ETFs have quadrupled in combined AUM from $0.5 billion to 2.2 billion over the last 5 years, And this product would be suitable for investors seeking to invest in large cap Singapore companies in a diversified approach instead of stock picking. SGX also hosts the largest and most liquid gold ETF in Asia, which is the SPDR Gold Shares ETF. For investors who wish to allocate their investments into precious metals, this ETF acts as a low-cost option with TER of around 40 basis points. The average bid-ask spread of 6 basis points facilitates investors who trade actively with lower transaction costs. One key advantage of this ETF is its price transparency, as it's traded on multiple exchanges globally. So I'll now pass the time to Wei Chin, who will share more on REIT ETFs. Wei Chin, please.
Thank you, Liren. Yeah, this is Wei Chin. I'm the ETF product manager at SGX, and thanks for joining us tonight. We're covering the next topic on Reits ETF, and one of the reasons why we decide to speak to this asset class is because it's one of the ETF that has gained more popularity across the last 12 to 24 months. In fact, the AUM, the asset under management of the 3 Reits ETF on SGX has crossed 600 million in fund size, and most of the growth was gathered over the last 12 months. There are a few key reasons why investors are gradually shifting towards this asset class to gain exposure, or rather to allocate their funds into this product, is largely due to 3 key reasons. One is on its cost. ETF allows investors to gain access to the underlying asset at a low cost, as Liren has highlighted earlier on. And it's more true for Reits ETF, because when we are comparing the bid-ask spreads for a typical ETF, like the Lion Philip S-REIT ETF, the spread is about 30 to 36 basis points, which is generally smaller than the basket spreads of 53. So investors, if you are buying into the ETF, compared to buying the underlying REITs, you are having a potential spreads alone, potential cost savings, maybe about 30%. And that is on top of the execution fees, right? Because when you buy ETF, you just execute once. But let's say you're buying underlying 20 REITs, you're executing it 20 times. And last but not least, since few years back, investors now has a tax transparency in terms of investing into REITs and REITs ETF, i.e. For most retail investors, generally income tax on the REITs payout, the dividend payout, is not taxed at the REITs or fund level, but depending on your tax status. So for most Singapore retail investors, generally the tax rate is not taxable at this point. Professionally managed is the second key point here. Automatic rebalancing happens for the ETF because it's index tracking. So the reason why you are paying the fund managers is because they will be the one who is doing the automated rebalancing for you. So imagine over time when a particular REIT has rallied and the price gets too high, and it takes up a high percentage of the portfolio, through the rebalancing, you will see that the proportion will be bring down, while the REITs that had a recent sell-off, the price has fell. During the rebalancing, the proportion allocation might increase. Corporate actions. So as you know, for those who have invested into REITs, generally you have you may have come across a rights issuance, or even dividend payout. So imagine you have 20 underlying REITs, you will have 20 dividend payment cycle. Maybe 1/4 of them do rights issuance. So you might experience need to subscribe for the rights from time to time, monitor the rights prices, and maybe do the execution, whether decide to sell the rights or subscribe to the rights. So for Reits ETF, the manager will take care of these decisions on the best interest of the unit holders, and that saves you a lot of time to monitor these dividend flows and right issuance. And last but not least, is a well-diversified portfolio. For those who have seen the 2020 sell-off due to COVID-19, you realize that the retail REITs, commercial REITs had quite a huge sell-off during March to April, whereas the data center REITs, logistic REITs, this has rallied quite a bit. So for those who are on the wrong side, you might see a kind of higher than normal drawdown on your REITs portfolio if you are invested only on retail REITs. Whereas on a Reits ETF perspective, you are getting exposure across office, residential, industrial, retail, healthcare REITs, and that allows you to ride through the storm during the last 24 months. Right, you can move on to the next slide. So besides the few advantages we have mentioned about the ETF itself, we should also remember, or rather look into the underlying asset itself. So for REITs, why it is itself is an attractive asset class is one of the key reasons is its correlation matrix. So imagine you are investors who are already holding perhaps 60% equities, 40% bonds, which most people advocate that as a typical portfolio allocation. By adding on REITs to it, it actually lowers the risk by adding some low correlation across the other asset classes. So this table gives a good picture. If you look at the first two rows on top, those are the Reits index. The correlation across the global bonds on the far right is about 6.64 to 0.68. And the correlation with global equities is of 0.73 to 0.77. So it's not really that highly correlated, and this offers you to further reduce the risk in your portfolio. So yeah, you can move on to the next one. So these are the three that I had mentioned earlier on that offers investors exposure into various sectors. In fact, beyond sectors, so Lion Phillip S-REIT offers pure Singapore exposure, Singapore listed ETF exposure, listed REITs exposure. Nikko AM offers beyond Singapore listed ones, also has Hong Kong, India, Thailand, Malaysia. And last but not least, for those who already have a pretty high exposure into Singapore REITs, you may and would like to diversify more offshore, you can also consider the Phillip Sjx APAC Dividend Leader Reits ETF that has more than 65% currently listed outside of Singapore. And on this table, I think a few key highlights you want to take note of is the dividend yield itself. So currently the dividend yield payout by these three ETF, and so we calculate it by looking at the most recent dividend payout compared to its current the trading price at the point of time. So we're seeing yield between 2.64 to 4.32. And this information you can find out from our ETF screener, which we'll share with you later on. We also see also the dividend distribution frequency, a little bit of variation, but in general, they pay dividend either on a quarterly or semi-annual basis. And two of the facts here down to take note is also the average bid-ask spreads. So as mentioned, if you look at the most recent ones, in fact, the liquidity for the trading liquidity due to the trading turnover has improved tremendously. In fact, as of August, we are looking at the spreads between 18 for Nikko AM Reits ETF to about, let's say, 23 basis point or 0.23% for S-REIT. So this also translate, a better liquidity has translated to a lower cost when you're buying into these ETFs. And last but not least, total expense ratio. This is a key parameters that investors should take note. So what is total expense ratio? It means that how much you are paying to the fund, to the fund manager in managing your investments. So as Liren has shared earlier on, typically for ETFs, we are looking at a much lower cost basis. In fact, most of our ETF is not as direct, it's below 1%. It ranges between 25 basis point, and then normally for REITs and for even fixed income, they tend to have a much lower total expense ratio. And just last one point to highlight, you can see the top 5 constituents of each ETF, and you may notice that there are some familiar names, largely because these are mainly market cap weighted ETFs. So those that has a larger scale in size, they will appear on the top of the list. Yeah, we can move on. So next, I just want to share on the fixed income ETF as well. So if you look at our current fixed income ETF product suite as of August, we have about eight fixed income ETF that ranges between Singapore dollars to Chinese yuan as well as USD exposure bond ETF. And if you look at the chart on the top right, that shows you the kind of where the yield they are sitting at. But one thing to note, as always, when it comes to investment, typically higher returns may come with a higher risk. So if you look at the one up on the far upper right, it currently gives a yield of, in fact, recently has gone above 8%, about 8.19%. But do note that the underlying bonds are generally lower credit rating, and we are talking about high yield, which means it has a rating of BB and below, including non-rated bonds. So you would have some sovereign bonds, countries that has a much lower credit rating. You also have China credit bonds that has a credit rating that is BB or lower. Right to the bottom left of the spectrum, then you have the much safer AAA top quality bonds, including ABF Singapore bonds, as well as ABF is, by the way, is one of the oldest fixed income ETF that is listed on SGX. AAA, the yield will be generally lower, about 1.7%, but you can see it's still able to offer investors a periodic payout in terms of dividends. And on the bottom right corner, you can see we have done a kind of illustration on what's the key differences between a high yield bond and a AAA rated bond ETF. Both of them has generated a higher total return over time. In fact, this is a total return chart, i.e. we assume that you reinvest your dividend that you receive from the fund. So between 2018 to 2021, high yield bond has delivered a return above 20%, whereas the ABF Singapore bond has delivered a return of above 10%. Right. But one thing to note, in between, wherever there's a market volatility, and we are looking at the March 20 period, where the COVID sell-off kind of got more serious, high yield bond tend to be a bit more risky. When it's risk off, the bonds that people might sell off is typically the ones with lower credit rating. The ones that investors like to hold to, as we call it, the safe haven, are those with AAA or single A, especially because SGD is kind of a safe currency. We have a good FX reserves. So during that period, you can see ABF actually done outperformed the Asia high yield bond performance. But of course, which also brings back to the point, higher returns come with higher risk. So typically for investors who are investing in the high yield bond, time horizon is a key factor as well. You may need to have a longer time horizon to ride through the up and downs of a more volatile asset class like a high yield bond ETF. So I just wanted to move on to, as you've seen in the chart earlier on, there are two of them focused on China fixed income, China exposure. So we want to dedicate maybe just a few minutes on China fixed income, or rather we call it the China bond ETF. So 4 key reasons I hope you can take away from this session on why investors are gradually moving, or rather allocating, be it institutions or be it retail investors, why China fixed income has gradually become one of their key asset class that they are looking to allocate into. First of all, rising demand for China bond. One highlights to share is that currently the offshore bond holdings of China government bonds is about 310 billion, right? And at this point, it's only about slightly more than 10%, slightly more than 10% of all outstanding government bond, and this ratio is a lot lower than other major economies in terms of foreign holdings. So you can see that there is still a lot of room for foreign investors to increase their allocation into these asset class. And we are talking about the major pension houses around the world, as well as major fund managers who tracks the world index. So that brings us to the second point. There is an upcoming index inclusion for China government bonds into the FTSE Russell World Government Bond Index. That is going to happen towards end of October, right? So towards end of next month, we are seeing over a 36-month gradual inclusion of FTSE government, of increase of the Chinese government bond weightage in the index. And because of this index inclusion, we expect about $150 billion inflows into China government bonds. Second point, and it's a straightforward one, I think it's much straightforward than the first point, is currently is above, it was above 3%, currently it's below, slightly below 3, but still close to 3% yield. And that is much higher compared to the other major economies in the world, which include the US, the European nations, as well as Japan. Its credit rating is is on par with Japan, higher than Italy, but slightly lower than the other countries. But you realize that the yield is more than doubled compared to some of the nations. Third point, diversification, and that is correlated to the first point because the ownership of Chinese government bond is low by foreign investors. You realize the correlation is generally lower as well if you compare the China bond price movement with the other major economy bond price movement. So again, that further reduces the risk to your portfolio, i.e. when other bonds exposure that you have, be it US or Singapore bonds, moves, the correlation with CGB tend to be lower. Last but not least, convenience, liquidity. If you ask anyone on the street, how do you buy Chinese RMB bond now, right? It's pretty hard because unlike other major US bonds or European bonds, you do need to set up onshore bond accounts in China. And certainly because bond is traded OTC, then you need to have connection with other fund managers to ask for quotes. And the clip size wouldn't be small. Unlikely you can buy $1,000 of China bond ETF from another fund manager, China bond from another manager. So ETF help to solve the issues, right? You can go through any of the broker. There is certainly a fees to pay through the bid-ask spreads commission. However, you are able to gain exposure instantly through this channel. Yeah. So these are the two China fixed income ETF or Chinese bonds ETF that currently listed on SGX. On the left, you have one from Sjx AM. It was listed back exactly 12 months ago, 21st September. The key highlights of this is the 100% Chinese government bond ETF, and it charges a total expense ratio of 0.25%. On the right side, you have one from Nikko AM. The composite of the index is slightly different. Apart from the Chinese government bonds, which make up 43%, it has about 57 that is allocated into the what we call the policy bank bonds. So be it policy banks or China government bonds, is all rated A+, so i.e. By Moody's, S&P, Fitch, they are treating all this as a same credit rating. So on a credit rating basis, there is not really a much difference between them, but do note that the issuer itself is different, which also brings us to the point, what is the key difference in terms of yield? You can see that at this point, at the point of the chart is about 3.2 versus 3.1. So yield itself is generally close between the two products. And at a different point of time, we see the yield of Nikko AM gets higher than ICBC CSOC. But in general, it shouldn't deviate by too much because the underlying composite is pretty similar. One thing to highlight for Nikko AM, ICBC SG China government bond, Chinese bond ETF is that it has two different, we call it the fund class. So investors who are looking to receive dividend You can look at the SGD fund class. It's a distributing fund class, which you can receive dividend on a semi-annual basis. But those of you who prefer not to receive dividend, but continue to reinvest into the product so that you can gain long-term exposure, long-term returns, you can consider the USD fund class, or rather RMB fund class with a USD trading counter, stock code ZHD. Yeah. Next, we have the SGD denominated one, pretty straightforward. 3 of them are all rated between A to AAA. The yield is generally lower compared to what we see for Chinese and USD bond ETF. It ranges between 1.16 to 2.28. And at the bottom of the chart, you can see the composite is also pretty different, right? Right from the right, you have 100% government of Singapore bonds. The one on the middle, you have a combination of sovereign, 28%, banks, investment company, insurance, and so on. And last but not least, on the left side, you have the ABF Singapore Bond Index ETF. Is about 88% government of Singapore bonds, when the rest are in quasi-government bonds. So the average rating given to this product is also at AAA. But you can see the due to it's a mixture of other issuer, the yield is kind of higher compared to the Xtrackers pure government bond ETF. I can move on to the next one. And last but not least, we have 2 that offer generally higher yield compared to the Chinese government bonds and Singapore bond ETF. There's good reasons. One of the key difference here, you are looking at a different credit rating as a whole. So for investors who are keen to have different credit rating profile of bonds in their portfolio, so i.e. you don't mind adding credit bonds, i.e. corporate bonds into a portfolio, which has a credit rating of perhaps between BB, single B, single A, double A, triple A. You want to have a mix. These 2 ETF do provide the flexibility. So for the one on the left side is about 70, close to 75%, I would say, is still considered investment grade. So when you say a bond is investment grade, you call it a triple B and above. So in this case, about 75% of the bonds are investment grade, while the rest are below investment grade, i.e. the high yield bonds. On the right side, I think I've emphasized earlier on, is about 57% on high yield and 40% non-rated. So this product itself do have a much higher risk in terms of its credit rating compared to its peer. However, then a higher risk is compensated by the yield itself. And just one more last point, right? The reason why a high yield bond ETF is gaining popularity as well to investors is because investing into a single high yield bond, i.e. single corporate bonds, in a single country, single sector, or even single company is tend to be higher, because if the company does default, the loss is total loss. Whereas a high yield bond in this case, it has over 300 over issuance. So the chances of a massive default among these issuance is not impossible, but it's pretty remote to have that many issuers defaulting at the same time. So i.e. The likelihood of a total loss is lower compared to a single issuance, right? Just want to point out this point. And also the geographical allocation, you look at the one for high yield bond, about 50% China, whereas the other 50% is spread across other countries. Again, to further diversify the single country risk of the product. Yeah. Last one, I just want to cover also on bonds ETF, Singapore First Domiciled Money Market ETF. So this is extremely liquid, in terms of or rather I would put it this way, the duration extremely short. It's about 3 months maturity, on average maturity. So i.e. you notice that the yield for this product don't change too much month on month. And this is suitable for investors who is looking to have close to cash form of investment in terms of its liquidity. Okay, so I think this is on the last part, which is the Chinese Equities Etf. Currently, there are 5 ETF on the Singapore Exchange that's available for investors who are keen to invest into the China equities market. And I just wanted to highlight the most recent one, Lion OCBC Securities China's Leader ETF that was launched just in August. So this allows investors to have exposure to both the shares listed in Hong Kong as well as shares listed in China. So we are talking about the Shanghai and Shenzhen exchange. We are among the world's largest exchange. You can gain exposure to their stocks, i.e. companies like Guizhou Maotai, the largest liquor maker, contemporary Aperex Tech, one of the largest battery makers. These are only available in China A-shares market. And today, through this product, you can gain direct exposure into this market, in these shares in the diversified approach. So i.e. again, you will in a single trade, you will gain exposure to all of these companies that are the major industry players in the market. Yeah, we can move on to the next one. So I just wanted to touch on quickly as well on 3 key reasons why we think investors should start early. First, when you start early, you can afford to put less aside, right? And that is simple, right? If you start with at 25, you have 40 years before you hit 65, assuming that's your retirement age. If you start at 45, you're only left with 20 years. Compounding effects, again, I think this is one of the common reasons for investing that most educators or fund managers has been highlighted, robo-advisors has been highlighting this. The compounding effect is one of the wonder in the world. And through compounding, there's a pretty good way for you to grow your wealth. And last but not least, I think we give some examples as well, like the high yield bond ETF. Certainly having a longer time horizon, you can ride through the volatility in the market. So the first point, we done an illustration here, assuming someone at 25 compared to someone at 40, you would only have a time spent of 40 years, right, for Mr. A to grow your investment, or rather your retirement funds, whereas you only have a time span of 25 years to grow your investment to 65 years old. So with more time on Mr. A's hands, he is able to make a smaller amount. He can set aside a much smaller amount per month compared to Mr. B, which has to set up a much higher investment amount per month. Compounding effects, I think we also did a simple illustration here. So what does compounding effects means? So straightforward, it means that whenever you earn interest, and if you do reinvest the interest, the interest also get returns over time. And the earliest, and therefore, if you do start early, you are giving the interest that it gets on a recurring basis more time for it to compound. And on the right side, you can see there's a chart that illustrates these results. We look at across 4 years, assuming a modest amount of $100. If you do get a 4% return annually, take your SA for example, if you're getting 4% return annually, at the end of the 4th year, you are looking at an investment amount return of 116.99, right? And that excess itself includes any compounding interest that you earn from the investments. And just want to share with you a rule of 72, right? So if you want to know how long it takes for you to double your investment, you just need to take 72 divided by your expected rate of returns. So for example, assuming I have 1 million, let's say 1 million is too high, $10,000 now, right? And I put it in a vehicle that gives me a 4% returns. It will take 18 years for me to turn it into a 20,000 sum, right? So yeah, so that's the rule of 72. Last but not least, riding through volatility. So we look at the bond chart earlier on. This one is on S&P, which is the most popular index globally that tracks the top 500 US companies. In fact, we do have a ETF that is cross-listed by SPDR on SGX as well. The stock code is S27. So for this particular product, you can see across the horizon that we have showcased here from 2016 to 2021, there was 2 periods highlighted by the 2 circles. Those represent the sell-off, right? And if you do have a time horizon that is longer, so in this case, we are looking only at 5 months, there's a good chance you can ride through this volatility. Yeah, move on to the next one. So last but not least, perhaps on how do you get started? I think I have shared a bit on the ETF screener, why our investors are using this to select their ETFs, because it gives them instant highlights on which funds has a higher return perhaps year to date, or even like has undergone a huge drawdown year to date, and then they can formulate their investment decision. It also tells them which one has a dividend yield, a higher dividend yield, if dividend yield is what investors is looking for. And last but not least, expense ratio, if a cost is what investors are sensitive towards. So these at a glance give you a comparison across these products. And you can also download the funds documents, and we strongly advise investors should be reading funds documents before they make any investment decision, because in the document includes the product highlight sheets and the prospectus that spells out all the risk that are associated in this investment. So like any other investment, even though it's ETF, is passively tracking, should do the due diligence to look at the fund's prospectus or fact sheets, understand really what's behind the risk, also to see what's the experience of the fund managers, if that will give you a level of comfort in your investments. Right. So this is just a quick glance at the specifications of our trading hours, and also who are the issuers available on the market. The most important one is the QR code on the top right corner, right? So do scan that code so that you can have access to some of our key materials. Yeah, I think that comes to an end from my part.
All right, thank you so much, Liren and Reits. So allow me to share my screen. Okay, can you guys see? All right, so rule of 72, that's something new I learned tonight. And I think it was a really good reminder from what Reits said just now, that we should really do our homework. So yeah, read up on the fund that you want to invest in, the ETF bond you want to go for. And it's safe to say that that was a super packed and insightful session all about ETFs. So I hope the younger audiences from this evening also took something away. Remember to start investing early. I think the chart that Reits showed just now, when he compared somebody who's starting at 25 versus somebody who's starting later, you need to set aside so much lesser when you start early. So now let's move on to the Q&A session. And we've got time for about a few questions. So yeah, for those in the Zoom webinar, feel free to use the Q&A button to post your questions. For those viewing on Facebook, feel free to drop your questions in the comments as well. So I would pass the time back to actually our speakers to take the questions. So Liren and Reits.
Reits, you're on mute.
Yeah, you're on mute. Yeah, okay.
Thanks. So maybe I can start off with some questions here. One of the questions I see is, how do you pick high yield SG bond as a beginner investors? I'm not sure if I understand this correctly. But if you are saying that, how do you choose if you're not buying to ETF, but you're looking at individual bonds? Of course, that if you are doing, you need to understand the company fundamentals very well. You need to understand what are the risks involved, what are the debt they are holding, what are the likelihood of them defaulting, So a lot more study needs to be put in place. I'm not an expert in this, but nonetheless, the reason why, again, bringing back to ETF point is that if you are really a beginner investors, you do not really spend time studying to individual companies. ETF does has an advantage because through an ETF, you are buying into a basket of companies, bonds, but rather than a single picking individual companies. So next question on ETF versus robo-advisors. What are the key differences? As robo-advisors uses ETF as part of their portfolio construction too. So yes, robo-advisor, we have seen it is on the rise. In fact, today there are a couple of them using Sjx listed ETF to form their portfolio. You have robos doing an income portfolio or Asia portfolio that uses Sjx listed ETFs. So what are the key difference? I think robo-advisors really, what they provide is the convenience to investors. You don't need to execute the trade yourself. You just transfer a fixed amount or a single amount to them, and they allocate into the ETFs. They will help you to rebalance depending on the mixture of ETF you want in the portfolio. So it's a bit more of a convenience, I suppose. And also maybe for investors who are new to investings, you're not sure which ETF you should be buying, you should be picking. You're not sure what you should have in the portfolio, even on stocks or equities proportion ratio. So if you've done your due diligence, the investment methodology approach of the robo-advisor suits your own thinking and your preference. There's a good chance that may go with the robo-advisors. However, if you are investors, perhaps who have your own investment methodology, you know what percentage of, let's say, high yield bond or investment grade bonds or REITs or China equities or US equities you want in the portfolio. Perhaps you already have exposure into US market, you want to look into China. ETF could be a good way, right? Because you just need to buy into the ETF directly. You are not paying fees twice. Because you go through a robo, likely you will incur management fee for ETF. You also incur management fee charged by the robo. So really depending on what needs do you have. If you fall to the category, you prefer someone to manage the entire investment portfolio for you, robo could be an avenue. But if you're someone who wants to have more, DIY, more control over the amount of bonds or equities you portfolio, then perhaps you could consider doing a DIY investing, which CIMB, of course, offer that flexibility for you to buy the ETF directly. Next one, I think the question is on what is the difference between normal and inverse ETF. Currently, we do not have an inverse ETF, I will call it inverse product on SGX. There may be potential issuance on such products on the market. Certainly, CIMB will be informing the clients when that happens. But in general, inverse ETF kind of tracks the negative performance of the particular index. So if you're investing into an inverse ETF, you are expecting the underlying index to drop in prices. So for example, if you think the STI is going to drop from perhaps 2000 to 2007 or 2007 to 2004, if you're expecting a drop in the index prices, then yes, inverse ETF could be what you're looking, inverse product again. Inverse product should be the right term that you're looking at. So next, how can a new investor start investing into REITs? Certainly through a broker platform, that's one of the most straightforward way. Or if you're looking at REITs ETF again through a broker platform, that's a straightforward way. What's a good return? Well, good return, this is subjective, but good to some, it might not be good to the others. But perhaps Lee Ren, what's your thoughts on this?
I think it really depends on, when looking to invest using ETFs, whether it's for capital appreciation or if it's just for dividend. So like Wei Chin shared, and earlier in our presentation on SGX, we have 3 different ETFs that is available on our shelf, and each ETF they provide investors with access to different geographical regions and even different sectors, right? So if you're looking at, let's say, an ETF that gives you, a good, consistent like dividend yield, an S-REIT ETF, the example, the Philip S-REIT ETF, that gives about 4.3%, and Nikko Straits Trading Asia ex-Japan REIT ETF gives about 4%, right? So I think if you're looking at you, and depending on what's your risk appetite, this is something that you could consider, for that type of returns.
Yeah. Thanks, Liren. Maybe I'll move on to another question. I think the audience has questioned about overseas REIT tax implication. So I presume this is relating to REITs that offer beyond Singapore exposure, right? Because you are saying that Singapore has tax, but what about Japan or Australia? Liren, any insights on this?
So in terms of the tax implications?
Yeah, so my is, of course, for investors, if you are looking to buy into a REITs ETF that has overseas exposure, one of the key points is to also read into the prospectus, the underlying product, because that itself would review or rather would disclose typically what the tax rate applicable, may be applicable to overseas, what is the withholding tax perhaps local investors may face when they buy into Australia or Japanese REITs. So we can't, of course, give a tax advisory over this webinar, but I would say do pay attention to the prospectus itself and understands. Obviously, from a dividend yield, you will know what's the expected dividend for the product, but you want to know how much it has been paid, how much the gross was before you have it. I think a good source will be the prospectus to understand what's the withholding tax rate applicable for each country REITs.
Richard, you want to take the question on tracking error?
Oh yeah, sure. So what is risk from tracking error for? Tracking error is, well, in ideal case, right? Ideal world, if you look at STI, if you look at let's say China Leaders ETF, what you really want to happen if you buy into an ETF is the return you get. So for example, if STI get a return of 10% this year, you were told that your TER, your total expense ratio, is 0.3%, then you should be seeing a return as 9.70. Likewise for any other equities ETF or bond index ETF, right? But you may observe that on the fact sheets, that might not be the case. You might not be seeing 9.7. Sometimes you see below 9.7, 9.69, 9.68. Sometimes you might see above 9.7, let's say 7.1, 9.72. So what's the reason for this deviation? Part of the reason is due to tracking error, because no matter how hard the issuer tries, there may be instances whereby they can't closely track the index, right? Because index is more in theory, is what the price should move, maybe based on the closing price. The index provider calculated the index movement. But in reality, when they are placing trades and orders on these products, depending on the market liquidity at times, market volatility at closing, there may be instances where they can't get the price, the exact price of what the index is used to calculation. So then it comes into a tracking error issue, right? And yeah, so managers normally they would disclose this information on the website as well. So besides looking at TER, you can also pay attention to what's their past 1 year tracking error, past 3 years tracking error, to understand how good the manager is in tracking the index. So in theory, a lower tracking error is, the better it is, because your investment objective is to get the index return. Having said that, there is a positive tracking error at times, i.e. because of the error, they are performing better than index. But again, that's not really the point, right? Because what you really want is the index returns. Next one, I think, is it encouraging to trade frequently rather than buying to hold? Depends, right? So what's the reason that you're trading frequently? Is it because you're a short-term trader? Is it because you have a view on the particular market over, let's say, a few days? Are you taking opportunity because you had a sharp sell-off, you want to trade on the rebound? So many reasons to do so. But if your objective is just, there's no specific reason for you to enter, exit the market, then maybe the advice is to hold long term rather than I would say overreacting to the market movement. Liren, what's your view on this?
Yeah, I fully agree with you, Reits. I think it depends on the individual. It depends on your investment horizon also, right? If it's a longer term investment horizon, and depending on your level of income and the commitments you have, right, you'll be able to take more risk. If it's a shorter time horizon, then it'll be more. It makes more sense to look at less riskier options that are available on the market. So yeah, I think it's really down to some of these factors which we have shared. Yeah, I think looking at the question, the last two questions are mainly platform related. Perhaps we could direct them to Josephine to share on the Driven to Learn campaign and what's coming up. So thank you so much, guys.
Thank you.
Okay, thank you very much, speakers. So you guys answered almost all the questions, which it's very great and generous of you guys. For the last two, there's one by Yuking. What's the difference between brokers like CGS-CIMB versus Tiger and Mumu? So we are actually not all that different, but the promotions that we run may be different. So for CGS-CIMB, we do have a service that's geared towards the younger audiences, much like Tiger and Mumu, and it's called Prosperous. So it's Prosper and then you as us. So you can check out the app on the App Store or the Google Play Store, and it is a simple way for millennials to start investing immediately. So you can deposit an amount into your Prosperous account. So open an account with us, deposit an amount, and you actually stand to enjoy lifestyle benefits, such as I think they have like spin classes and martini tasting sessions and stuff like that. So yeah, so without further ado, I mean, it's getting a bit late, and so for those who missed out on the QR code earlier, this is the QR code to scan to register and participate in our Driven campaign. So 3 more months to go, and you can head to our website here, and you can actually check out the live leaderboard, which we update every month to see who are the top 10 traders each month. So you can see how often they trade, and you can see how many tickets they earn and how many tickets you need to have in order to be in the top 10 and to be in the running to win a Tesla Model 3. So next, we are also on Facebook, the Gram, LinkedIn, YouTube, and Twitter. So do follow us for campaign updates and for more free webinar sessions coming your way. Yeah, and last but not least, if you've missed our previous sessions, fret not. Register to access all our webinars on various markets, be it Singapore, US, China, and more. When you register yourself as a Driven to Learn participant, stand a chance to win $50 Takashimaya vouchers or 50 ringgit Grab vouchers when you register yourself by scanning this QR code. I know there's been a lot of QR codes this evening, and register yourself as a Driven to Learn attendee. So sign up via this QR code now. Thank you everybody for your questions, for attending this session, and we look forward to seeing you in the next one. So do follow us on our socials to stay updated. Thank you very much once again, SGX, Liren and Wei-Chin. I think that was a fantastic presentation this evening, and we look forward to having you guys again at CGS-CIMB. So yeah, thank you very much, and good evening, everyone. Have a pleasant evening ahead. Thank you.
Thank you.
Thank
you,
you.
everyone.